Hello, I'm Mark Abssy, Head of Indexing at Tematica Research, and welcome to the week ahead. So, as we usually do, we'll take a look at last week and then what's on the calendar, economic and otherwise, coming up. Basically, the last couple of weeks have been markets hitting all-time highs, right? We've gotten now, I guess, final clarity, if you want to call it that, on tariffs, right? We hit the final deadline. So now everybody has tariffs on them, whether they like it or even realize it or not. And I'll talk a little bit about that in a little bit. But basically, last week it was definitely a Mag 7 and tech tilted week, if only because, the Dow was up 135, S&P 500 up 243, and the NASDAQ Composite up 387. Okay. One of the things we've been talking about, it seems like for forever, but really it's been the last couple of years, of course, is concentration and concentration risk within the broad indexes. So in as much as we have S&P 500 at, call it close to 6,400, 6,389 on Friday's close, when we look at the past week, and as I've talked about before, what I've been seeing kind of day to day in the S&P over the last at least a year to date, if not longer, is that the top 10 contributors of return to the S&P are giving out about 50% contribution to that return. Okay, there's been a couple of times where it's dipped down to maybe 40% contribution, but there's been plenty of times where it's been higher, right? And indeed, this past week, if you look at SPY, all right, SPY was up 2.49%, and again, when you look at that, top 10 names for that were, call it 85% of contribution to the total return. Now, when you break that down even further and you go line by line, 50% of that were your top three names. Again, in terms of contribution, there were names that had returns, absolute returns, much higher than these other names, right? So Apple, NVIDIA, and Broadcom, right? Apple up 5.73, NVIDIA up about 8%, Broadcom up about 2.6%, right? That in itself, those three names were 50% of the return of the S&P 500, as proxied by SPY over the last week, right? And so when we look at the broader list of holdings, in terms of absolute return, the top 10 there, every name was over 10%. IDEX Labs was your best performer last week in the S&P 500 at 22.87%. Palantir, Arista, Axon, Micron, right? These are all, ranging between 13 and 21%. And then when you look at the bottom end of things, right? Of course, we all saw what happened with Eli Lilly. I think they were down about 17% on the week, but Paramount down about 20%. Vertex Pharma, 21%. Supermicro, 23%. Fortinet, 23% for Fortinet. Gartner, down about 30%. So, when we look at broad indexes, it's great to say, the index was up or the index was down. But you really need to look at what's going on inside that index, okay? And that's kind of a segue into, what we're doing here at Tematica, right? When we look at these targeted exposure models, when we look at these strategies, what we're really doing is we're looking inside the broader economy. We're looking inside these broad indexes and saying, what are segments that are distinguished from the broad sectors that they are in, right? So when we look at strategies like digital infrastructure, home building and materials, right? The Rebuilding America model, right? Artificial intelligence, and I can go down the line. What we're really saying is these are pockets of economic activity which are either not being captured because they're, from a traditional sense, kind of cross-sector, right? because the way the world looks at everything is through traditional equity classification. So people want financials exposure, they want industrials exposure, they want consumer discretionary exposure. A lot of these targeted exposure models, right, which again, some people would refer to them as thematic, and indeed I think they started out as thematics. But a lot of these models, they are kind of cross-sector in terms of traditional equity classification schemes. So, the idea that you can, pull up a fund or pull up, like you just can't find it in a traditional classification system. So that's where these models step in. That's where these strategies step in. And indeed, even if we take, the NASDAQ composite, right, up 3.87%, great. Of the 20 some odd models that we have, fully 9 of them fared better. And by the way, fared better without the heavy weights of all the Mag 7, right? Our EPS diplomats was, mind you, 2 basis points higher, but it was still higher, right? Digital Lifestyle, CHIPS Act, nuclear energy and uranium, right? So when we do look at these strategies, when we're looking at these models, again, we're looking beyond and through both broad sectors and what we would call traditional equity classification sectors, right? So when you're looking at schemas like BICS, like GICS, other of these schemas, they're very siloed, and there's not a lot of kind of cross-play across them. But the reality is that economic activity, it doesn't care, right? So if you look at a digital payments, either an ETF or even a strategy, you're going to find consumer companies, you're going to find tech companies, you're going to find financials, all right? Which kind of the old way of looking at things, which, by the way, this is a spiel that I've been given for over the last decade, but it's still true, right? It's just not captured in a conventional sense. So anyway, last week, all-time highs, great. Things are moving along. We got clarity on tariffs, if you want to call it that, and that's it. So looking forward, looking ahead to this week, more tariff-related things, but basically we have CPI coming, we have PPI coming, so that is going to give us, again, more color as to the inflation picture, right? The expectation is that everything's going higher, not kind of hugely higher, but higher nonetheless, right? We're looking at year-over-year top-line figures bumping up maybe, maybe like 10 bips or 15 bips or so on those top-line numbers for PPI and CPI. Now, with regards to tariffs, one of the things that I wanted to chat about is kind of what's the tariff endgame, or what's the market going to do about tariffs, right? And I was doing some thinking earlier today, and here's kind of the best case scenario, at least from my perspective, which is there's been a lot of discussion about, well, of course, prices are going to go up for consumers, and they will. But the question is, how much, right? And so is there kind of a medium or kind of a middle ground between companies just absorbing all the tariff costs, which we know that they don't want to do, right? Because they don't want to blow up earnings, they don't want to blow up their income statement and their cash flows and everything else, just because to accommodate prices. And there's certainly, although there have been times in the last year, or at least since the beginning of the year, where the administration has attempted to enforce kind of price quotas, if you wish, on certain industries and on certain companies. Last I checked, this is still a capitalist economy, so that's not really going to work. But basically the two ends are companies do nothing except pass 100% of the tariff costs on to consumers, which is going to pinch consumers and create other issues, potentially depending on how elastic or inelastic the company's products and services are, create real issues in terms of top line growth, or even just maintaining top line anything. The other side of that is company says, hey, you know what? Instead of doing a $10 billion stock buyback, we're just going to eat the tariff costs and we're going to keep our companies happening, right? Well, clearly the street's not going to like that. And also that's going to impact on earnings. So, my question is there a middle ground? And I believe there is, where, yes, some costs are passed on to consumers, some costs are absorbed by the company, so it's such that there is kind of a neutral or a net zero effect to company earnings, which is to say, customers, the company finds that sweet spot for raising customer prices as to not scare them off. Takes a little bit of a hit on earnings to subsidize the tariffs, and the net result of that, basically is zero, or at least it's a negligible number that's not going to impact too greatly on earnings. Now, only time will tell, and there's a lot of moving pieces to that, but that kind of in my/our estimation is probably kind of a best case scenario for how tariffs play out for the rest of the year. And again, it comes down to how strong are companies, what kind of margin they have on their products. Again, this whole question of, is their product or service elastic? Is it inelastic with regards to pricing? And that's something that's, going to happen on a company by company basis. And surely, some companies will figure it out. Others won't. Others might find that maybe they can't even operate in this environment because their margins are too thin, or the way, their position is too precarious. But again, time will tell. Bottom line is, we're coming through earnings. We're certainly over the bulk of earnings. And so, with tariffs now in place, we'll just have to see what the rest of the comments are in this earnings season. And then we'll just have to gear up for Q3 earnings to see what kind of impact really these tariffs are starting to have on companies. So that's it for now. Like I said, this week, CPI, PPI, undoubtedly we'll get more color on tariffs from the companies that still have to report for Q2. And that's about it. I don't know. Crypto's off to the races again. For those of you that are kind of playing along at home, the SEC indicated that it was going to allow in-kind create and redeems with exchange-traded funds for these, spot crypto products. And that potentially is a huge thing because, of course, it opens up a whole bunch of supply, and it's still not 100% clear to me how that mechanism is going to work. It's not like John and Jane crypto holder can walk in off the street to their brokerage and say, hey, here's my 5 Bitcoin. I want to do a straight swap in for shares of the ETF. There are mechanisms to do that, and there are ways to do that, but it's not like there was a gold product that you could create and redeem physical gold with. So you, as a regular shareholder, I think it was a Merck product, where if you wanted to sell shares, you had the option to either receive your the proceeds from the sale of your shares, or you could receive physical gold. Now, we're not there in crypto ETF land yet, but I think that's kind of where folks are pointing to and hoping for. But in the interim, we've got Bitcoin up at 118,500. We've got Ethereum crossing over 4,000. Ethereum over the last few years has basically been range bound between, call it 1,500 and 4,000. So we're definitely across the 4,000 barrier. It seems to be sticking. Of course, all the Ethereum bulls out there are saying, Ethereum 20,000 and all that kind of stuff. That'd be great. We'll see if it happens. But that's what's going on there. We got VIX at 15 to close out the week, down about 25% over the week. Let's see if that holds. The 10-year at a 428, bumping up a little. And there you go. So thanks, and we'll see you next time.